Hello, everybody. This is Eric Hale, and I'm joined by Greg Jensen.
Good to be with you, Eric. Glad we're here.
Yeah, good. Before we get too far down the road, let me show you what's going on over at the Hale household today. These are beef ribs, which have been on the grill since about 7 this morning. Another 4 hours or so to go. These are like Fred Flintstone kind of ribs. They're going to be pretty awesome. That's what's happening at the Hale household today. How's things going on over in where the Jensens are?
I got a foot of snow in the last 24 hours. So I shoveled snow this morning. Again, it's almost April. I think we moved to Antarctica. The poles have shifted or something. I don't know.
Wait a minute. Isn't it like almost April? Isn't like, aren't there like flowers crocuses supposed to be coming?
Exactly. That's the story, right?
Yeah.
But, well, anyway.
So what are we doing here today?
Well, we've got a lot of feedback. Thank you, by the way, for the feedback and some of the questions we've asked about some things you really want to see us do some recordings on. And one of the ones that Eric and I kind of landed on that I think would be really good would be common mistakes that investors are making right now. And although we would love to do a recording about all of them, that would be a massive. We'll break them.
What are you trying to say? Are you saying people make a lot of mistakes?
I did. I know when I first started trading, I did, and I've spent a lot of years and a lot of expensive tuition in figuring out how to not make those mistakes again. But I think we've decided on a couple of them that we could work on and share with you guys about a couple of really important ones that if you need to learn how to not make these mistakes. So I think we wanted to start today with talking about choosing the right instruments to trade. Maybe more specifically, what makes a good options chain? What makes a good stock or ETF tradable in the options market?
Yeah, that's exactly true. So I don't think we can address all. We'll try and break down some of the common mistakes, but I think one of the biggest ones is that I certainly made and cost me a lot of money was not recognizing the importance of having a good option chain. And it's a different mindset, I think, when you trade options. Stock traders have one tool, and that is buy stock and sell stock. The only other way they make money is maybe by collecting a dividend. But there's really only one strategy, and that is buy something that's going to go up. And so I often use the analogy, if your only tool is a hammer, everything looks like a nail. If you have a hammer, you got to go find a nail. Now, if you're trying to get a project done around the Jensen household, which way does it work? Do you go into the hardware store and buy a drill and then come home and look for a project to do? That's not how it works.
Right.
So the strategies that we teach are tools. And the approach is, I know what I want to get done. What's the right tool to use that? So when we trade options, we don't have to be looking for the nail. We have more tools than a hammer. And so the approach is, instead of looking for the next bullish stock or next whatever instrument, we try to get to know an equity very well and then apply the strategy that's going to work for whatever the sentiment is. Really simply bullish, bearish, or stagnant. But it's more than that, because we make money on the passing of time or lose money. And we can make money with changes in implied volatility. So I did a really good class last night for Options Animal on double diagonals and how you can benefit from changes in volatility. Anyways, what's really important, though, for any of those strategies is that you have to have really good option chains. And if you don't, I know personally, I've lost as much as 30% just to poor liquidity. So the question is here, how do you identify which equities have good liquidity? And the concept of liquidity is how easily things flow. You hear liquidity talked about all the time, and it is very important to the market from different aspects. And it's extremely important for options. So there's like 4 or 5 things that we look at to determine option liquidity. What do you try to tackle first? What do you go to when you're thinking about a new equity maybe, and you're starting to look at an option chain, what are the things that are important to you?
So before we jump into that, let me add one other piece of, real world trading learning experience that I went through, that emphasizes this point. Back in 2008, on Lehman Day, actually, I remember I had seen the writing on the wall. I knew the financials were in trouble. Bear Stearns had gone under a few months before. They really hadn't fixed things, even though at the time Fed Chair Bernanke reassured us that everything was okay. And I still decided to do some speculative. They were more protection for my overall portfolio, but I bought puts on the SPY, which arguably the SPY, an ETF that tracks the S&P 500, maybe the most liquid instrument that's out there in the options world. And I bought puts that make money when the market goes down. And I don't remember the exact price I paid for them. I want to say it was around $5. And on Lehman Day, when the market opened down huge and there was massive panic in the streets, those options, even though they were the most liquid out there, went huge on their bid-ask spread. I mean, it was like bid $1, ask like $15. And that's a really abnormal situation. But the reason I bring this up is I still ended up selling my position and got a nice profit out of it. And the reason why is it was a very liquid instrument. So these liquidity, that what we're talking about, a lot of times liquidity isn't a big deal when you're trading stocks, unless you really need to get out of the position. And then liquidity is one of the most important things you're looking at in what you're trading. So some of the key things, and maybe we can go through each one of them. I'll just rattle them off right now, and maybe we step through each one of them, Eric, just a little bit, is tight bid-ask spreads, penny-wide price increments, the number of strike prices that are available to trade. I mean, sometimes it's $1 if that's possible. Some $2.50, $5 spreads. Those are common ones when you start to get into some of the higher priced stocks. But if you've got dollar strike price spreads, creates enormous amounts of adjustability of instruments. The number of expiration series that are available. So if I've got more than just 2 or 3 months available, that helps me out. And then lastly is this topic that you already mentioned, the idea of implied volatility, and maybe more importantly, how to being able to predict that implied volatility and those changes. So tight bid-ask spreads, I'm going to say that's probably the most important thing. That's really your market.
I've got to agree with you. A lot of people go to volume and open interest and looking, and certainly it is related. They want a threshold for volume and open interest, and that is important. But it's quite possible that, maybe something happened in the market and there was a huge rush to buy options, and you'll see big open interest, or maybe on a specific day, you'll see a lot of volume. And generally more volume, those are open interest is total contracts that existed in the morning. Volume is the number of contracts that traded that day. Open interest doesn't change throughout the day. Volume does. You see volume getting bigger. And that is definitely important. However, it's sometimes there could be a day when there's a rush for some reason, maybe some event or something. And so you can see some distortions in those. So I think the best indicator of liquidity is to look at the bid-ask spreads and do some very simple math. So the rule of thumb that I use is to look at a monthly expiration. So we've got expirations that are on weeks or months, and I'm just filtering here on monthlies. So April 21st is the monthly. You want to look at that expiration series and look at the first out of the money call.
Are you sharing your screen right now, by the way?
Oh, shoot. I'm not sharing
I'm not seeing it.
Well, it's in my head. Can you see it in my head? All right. Now I'm sharing.
All I see is those ribs in your head.
Oh, man. Those are going to be good. Oh, I was going to cook those things up. I had this plan to, you should, when you cook barbecue, Really important that you give it a good rest before you serve it. It allows things to really get tender. So I was planning on going down and spending the night with Connor, my son. He lives in the city, he lives in Chicago. So I had plans for, packaging him up and heading down and getting down there. We were going to eat him together. He's got COVID.
Oh, I did hear there's another round of COVID.
He texted me this morning. He says, Dad, I got COVID. So looks like I'll be eating all those ribs by myself. All right. So let's circle back around to this test that everybody should do. It's a very simple formula. And there's different formulas that people could use. The formula that I use is to look at the first out of the money call for the expiration that's about a month from today. That's the monthly. So a monthly expiration series. Weeklies are going to have more poor liquidity, and you can see that. But the formula that you use, and I've got this running spreadsheet that I use. The formula is to take the difference between the bid and the ask and divide it by the bid. So here's an example. We've got Apple that's bid 520, ask 530. So it's just Apple bid 520, ask 530. So this spreadsheet is going to calculate and tell me that math, the difference between these. You can see I've had this list running that I look at it at different periods of time. But for this Apple example, it's a really simple formula. Difference between the bid and the ask divided by the bid. And there's other rules of thumb people can use too. You can use the mid or divide by the ask. Just the numbers over here change a little bit. If it's 2% or less, it is phenomenal. And this is less than 2%. It doesn't get any better than that. And you can think of this percentage as the tax you pay for the right to be able to buy and sell that equity. Now, you might get a little bit better pricing. Yes. I know that I'll try and get filled in the mid. Not always going to happen. But if it's less than 2, it doesn't really get any better than that. It's about as good as it gets. You'll find like the SPY, Tesla, Apple, some of these that are very highly traded.
Microsoft, Google,
Amazon, NVIDIA, IWM, even AMC has good liquidity. So you'll see really good. So anything less than 5 is okay. I jumped to the 10%. If it's more than 10%, you probably should just walk away. And one of the things I wanted to address, maybe we'll talk about at the end, people ask, well, are there strategies I can use when the liquidity is poor? And I really want to trade it. I always say friends don't let friends trade equities with poor liquidity. So I really would want to probably suggest that if the liquidity is more than 10%, that's going to bite you in the butt. Greg told a story about how the SPY liquidity got really bad, right? It's normally 2%, sometimes 1%, sometimes less than 1% on the SPY. This is probably the SPX. What is this?
I think the one right below.
That's the SPX. Look at the SPX, 0.29%. The SPY is 0.68, less than 1%. Excellent liquidity, excellent, very, very tradable. You're not giving money up to the slippage and this is the money the market maker makes, and the market maker has to get paid, and they're either going to make it on volume or they're going to have a wide bid-ask spread. And you look at some of these equities that you see some that are 70, 133%, that you're not going to make money on those. And what's going to happen, as Greg mentioned, you can get it. You might be able to get into the trade, but Murphy's Law tells you what?
Yeah, you're not going to get out.
You're not going to get out of the trade at a profit. And it's happened to me where I've had to give up 30% just to break even when I should have made 30% or maybe 15 or 20%. I had to give it up to the bid-ask spread. So I think a lot of traders need to change their frame of reference from I need to trade this equity to find equities that have good liquidity. We don't have to have a stock be bullish to make money. We can make money in stagnant trends or bearish trends. So what's really important, I think, is finding the good liquidity. I think that's hand down the best thing that you could look at.
Yeah. And as the example, I know you brought up a really poor one right now. If you wanted to show that, I don't remember who it was, but the example, you had one on your spreadsheet as well. When you're dealing with an equity that has a really wide bid-ask spread and you try to trade an option on it, you can be right. I mean, the stock can actually have a bullish move. And if you're going in and buying a call option if you've got one that's really wide, if it's bid $6, ask $8, you have to have a $2 move in that option just to cover the bid ask spread. Well, if you think about it, that's a 33% move in the underlying instrument, or not the underlying, but the option instrument you're buying. You have to have a 33% move just to get to break even.
So I always, when I teach this class and talk about the importance of liquidity, I want a real-time example. What I usually do is go to Investors Business Daily and then look at their stocks on the move. And here's one that's got a 22% move today. And so people are salivating, oh man, is there some way that I can make money? And a lot of option traders are attracted to options because the leverage that you spend a lot less money. You don't have to buy the stock, and you can, potentially get a lottery ticket that goes way up. So this November, Sierra, Charlie, let's take a look at that option chain. And Greg and I would look at this right now and just walk away. It's, have you ever had a relationship, ever been in a relationship with somebody you wish you never met? I hate to say it, you see it, you have a friend who's dating a girl who's really hot, but like right now, this stock's really hot, 22% movement. And that she's going to be trouble, she's just, it's going to be dangerous. That's what this equity is. Let's look at April, the April expiration, the at the money. So the stock's trading at 39. The 40 strike is bid $1, ask 165. And you can see the volume and open interest in here for the entire month. The only place where there's open interest is at 30. And today, 4 contracts have been traded. Ladies and gentlemen, if you trade NSSC or whoever this company is, you are the market. You are the market. You'll try to, so what'll happen is you'll be cheap and say, I don't want to buy this at 165. I'm going to try and buy it at 150 or maybe at 145 or maybe 160. I don't know. And what's going to happen to the bid ask spread?
Yeah. All of a sudden your ask will change to 150.
Or the other way. It'll get, it's going to go the other way. The ask will get wider. It'll go the other way because the market makers say, there's a nibble on my line. Like there's somebody who wants to buy.
Look at the put side. The put side's even worse. Bid 30 cents, ask 265.
Ouch. So So let's look at the numbers here. So NSSCC. So 135. Did it move while we were talking? I think it did move while we were talking.
It was 105 to 165.
It was 105. So they know we're looking at. So the market maker knows there's fish around my bait.
Somebody pulled up an options chain. Move the order.
Yeah, I'm not saying that's what happened, but sometimes it sure feels that way. They don't actually know that I'm looking at the option chain, but my guess is that there's probably somebody out there trying to trade it because they're looking exactly the same information that I am. Is they see this Investors Business Daily and say 22% move. Maybe I can go buy, some options or something out there. So there are people trying to make money off of these, and I'd be really. So when you do this math, just understand you're going to pay 22%. You might get a little bit better pricing, but it could be a lot worse. So is it okay every time you do a transaction to underpay or overpay and end up having that cost you 22%? So whatever you want to make has to be more than this 22%. So that's probably the most important thing that I look at. And like I said, it's a do not pass go. If this is over 10%, if you really wanted to trade this company, just go buy the shares.
That's the answer. If you really want to trade it and the option liquidity is just horrible, you're better to just buy the shares.
But then again, why don't I want to do that?
Because you're going to run.
What happens if it goes down?
Yeah, exactly. I can't protect it. This is still a lottery ticket, especially in stock that's up 20% today.
Oh, look at this. The volume updated while we were watching it. So someone must be hearing me. 31 contracts. It was 0 just a few seconds ago. So it just updated. There are people trading this, and it is getting some attention. So that's the first thing I think is important. The next thing that we talked about, what was the next thing you mentioned?
The next one on the agenda was penny-wide price increments.
So look at the prices here. what's the penny digit? They're all fives and zeros.
Yep.
I mean, if I get change and the cashier asks me if I want my pennies, I say yes. Like, if you're going to round to a nickel or a dime, if it's in my favor, I'm okay with it. But the pricing here on something that's $1.65, if it only moves in nickel instruments, that's significant. So you can just look, if you see all zeros and there's not a lot of fives here, that is a crappy option chain. If you look at, here's JP Morgan, and you can see penny wide increments that are in there. So if you get far away from the money, we get to the zeros and fives, but where people are trading, you do see some penny wide increments. By the way, I don't know if it's still the pilot program, but we always refer to this as the penny pilot program, which started in 2007. Yeah. Everything used to trade in nickel instruments. And the OCC and some of the markets got together and said, because clients demanded it. And I did pull up a list of, I just got this yesterday.
I may admit how old I am by saying what I used to trade them in. It was quarters and eights and
quarters and eights. Yeah, I remember
a teeny. You know what a teeny was?
What's that?
A teeny was a 1/16th.
1/16th.
Yep,
I do remember. I actually learned my fractions, at least the quarters, the eighths, the sixteenths, as whatever, because I used to read the stock charts and they were always in eighths, and I figured that out. But there are 426 or 425 equities. This is downloaded from the OCC on equities that are part of the penny pilot program. So I don't know if it's still considered pilot, and you can see the big ones. And these, Greg and I were mentioning the equities that tend to have really good liquidity. These ones that are trading millions of shares a day, those have good liquidity. And these down here at the bottom, they do have penny wide increments, but maybe we're getting into things that are less liquid here. So probably want to be honing in on equities that are near the top. And there's probably a good 150 equities that have really good liquidity. So the first thing is the bid-ask spread. Keep that around 2% is ideal. Less than 5 is okay. More than 10% is bad. The next thing is penny strikes, penny prices. What's the next thing after that?
The next one would be your strike prices. And JP Morgan's a good example of this one as well, is just having dollar increments on your strike prices instead of, fives or 2.5s or even 10s in some cases.
Yeah. So you got $5 wide. So where's support on this thing? If support's maybe at 38 or 37, where your choice is 40 or 35. So yeah. you don't have any ability. What if I want to do 41 or 42 or 43? Now you could literally call your broker and ask them to call the market maker to create a strike. That can happen. You say, I wish there was a 42.50. Your broker could probably reach out and say, hey, I got somebody who wants to buy a 42.50. But again, you're the market, and then your pricing's not going to be great. So if that's what you need to do, you're probably look at now the bid has gone back to, it's bouncing around 140.0. So it's interesting that it's bouncing around in there. And the price of this option's only increased by 50 cents today. Some weird stuff going on. So the strikes, you want to see lots of strikes, and you hopefully, some of the higher priced ones, like I'll pull up Apple. So Apple's $2.50 wide strikes, because it's also trading at 158. So $2.50 wide. But once we get below 150, there's dollar wide strikes. In some equities, you'll look at like the SPY, which if we look at the shortest term expiration, sometimes we get 50 cent wide. No, it's not far enough down, but sometimes you can actually see some equities with some, actually there's a 39.50 or sorry, 3975. Yeah. Somewhere there's one that's, I can tell because there's a gap here. So only dollar wide, but sometimes we see equities. This Ford has those weird strikes because they had the split, but yeah. So they've got these 35 cent equities, but you will find some 50 cent wides. Sometimes I'm looking around for those strikes. Yeah, I'm having a hard time finding them. But sometimes you'll find some strikes that are smaller than a dollar, especially for lower priced equities.
And again, the reason this is important as you're looking at your trades is not just for entering the trade and finding an exact strike. Maybe if you were wanting to define a support level on a chart and say, I think this, Apple's got support at 157. So I want to buy a 157 put along with my stock position is an example. But it also comes into play when you start thinking about your secondary strategies of, how do I make an adjustment to this? And do I want to roll this option out in time? And when I only have $5 increments to roll it to, I'm limited as to how creative I can be. And that's true for both the individual strike prices that I'm talking about, the $1 versus the 250 strikes, but also the number of expiration cycles that are also available, which is the next thing that you would look at in deciding whether your options chain has got good liquidity or not, is how many different cycles I have. So in Apple's case, it's a really liquid example in the case that I've got an option that's got up to 3 years almost.
997 days.
997 days I can buy an option.
1,000 days you have to look. So Greg mentioned the importance of expiration. So that's the horizontal aspect. So the strikes would be the vertical. So looking vertically, we want to see lots of strikes and making sure that we can be able to buy and sell around levels of support and resistance. And then the next thing is the ability. One of the most common adjustments is to roll an expiration, maybe get a short option, and you don't want to get assigned or whatever. You roll. Like I have some Tesla trades every week. I roll these options, bringing in $50 a week. Not bad. From rolling those options, eventually I'll get assigned when I'm good with that. But rolling to the next expiration, if we go to an example like this NSSC, I've got, if I did, maybe let's say that I did this 80-day covered call, which is a very common strategy. So to go out about 3 months, sell a call at the money, and then decide that I don't want to get assigned, I need to roll. So you do the adjustment, you roll to the next expiration series. Now, all of a sudden, you're sitting here waiting 90 days until there's another expiration to adjust against. So this is another reason, looking in the horizontal direction, making sure that we have plenty of expiration series to be able to adjust to. The more, the better.
I think that's kind of the answer to all of this question, is the more, the better. A lot of times people have pointed to the increase in popularity of options and put a negative spin on it, that there's more speculation that's going on in the market, makes it harder to trade, it's more volatile. And although there might be a little bit of fundamental truth to that with some of the gamma impacts that the tail that wags the dog type of an impact, for the most part, I'm going to disagree with the negative aspect. I actually think the more people there are, the more money there is in the options market, the more liquid it is, and the better it is for you and I as individual investors to be able to get in and out of trades. And that's really kind of what we're measuring on all of these fronts, is the more, the merrier.
Yeah. So we talked a little bit about like strategies. Some people say, I really want to trade, maybe your brother-in-law works for NS and he's the CFO and gives you insider information. I'm kidding, not kidding.
Don't trade that. Yeah.
But maybe you worked for this company, or maybe this is your industry and you happen to know this market really well and you really, really want to trade it. People ask me like, well, if it's got terrible liquidity, what strategies? And I think the covered call with assignment is the primary exit, meaning you sell a call at the money, in the money, let it get assigned and sell your stock. And unfortunately, the people that are thinking of that strategy, they don't want to sell their stock. It's just, I've been burnt by this too much. And you can see the liquidity, the pricing, the bid ask is floating around here. Let me just tell you, when it comes time to you to get out of this, it's going to be ugly. And I've been down this path so many times. And what I try to do is I tell myself, I'm thinking like a stock trader. I'm for some reason, why do I really want to trade this? It's the latest shiny thing. It's catching headlines. It's making a big move. It's very exciting. Everybody wants to jump on this thing. And it's come back down actually since it was up 22%. Now it's come back down a little bit. So I try to, think about where my successes come from, and, taking gambles on these flash in the pan, sort of meme stocks, in the long run doesn't make me money.
Yeah.
So
No, I'm gonna agree with you on that.
There's one final thing that is for what makes for a good option chain, and that is implied volatility. That it should have predictable implied volatility. It should be something you should be able to develop a feel for how implied volatility is going to change. For some equities, there are very predictable patterns that happen around events. And I think of the ones that are on the top of that list that we were looking at. Here's an example of Netflix, and this is from iVolatility.com. There's two indices here. One is the historical volatility index, and the other is the implied volatility index. And implied volatility is really simple. It's the expensiveness of options. It's the risk premium that exists in insurance. So when you buy insurance, there's a calculation that's done. What is the product that I'm insuring? What's my deductible? What's my term? And then there's a risk factor that goes in there. And your actuaries, people who set prices on insurance, have these probability-based sort of numbers that go into their formula. And that's what implied volatility is. It's the risk of movement. And we see throughout the year, this is Netflix, where the gold line goes up and then drops, goes up and drops. And somebody who's familiar, I'm like, so this happens 4 times a year. You don't have to be a rocket scientist or some sort of scientific analyst to tell me what's going to happen from here. It's probably going to go up a little bit more, and then it's going to drop. And why is that?
Well, it's the uncertainty is now certain,
right?
Because that uncertainty
what is
priced in with earnings.
More specifically, right? What is it that's making this gold line change, Greg?
Yeah, it's earnings. It's the anticipation of an earnings event that is unknown for the quarter, and so as investors start to fear or speculate about the upcoming quarterly announcement, the option prices get expensive. And then once the earnings announcement comes out and the CFO comes and reassures investors, hey, we're still doing good, we're doing great, the fear just comes dropping, or the speculation comes dropping back out of those option prices. And so you see that gold line being very predictable. Another one, you just pulled up Foot Locker, obviously a really good one. Intuitive Surgical is another stock that in the past has always been very predictable about their pattern of implied volatility, where you see these spikes in anticipation of earnings and then a subsequent drop once the earnings event happens. And so, yeah, this becomes tradable.
This is a 2-year chart going out a little further, and you see this gold line. It's almost like a sinus rhythm in your heart. I mean, it goes up and it does other things. I mean, there's other times when it moves on its own for other reasons. But the one thing you know for sure is when this is high, options are expensive. When it's cheap, when it drops, options are cheap. Now, not all equities follow that pattern. That's Netflix. This is Foot Locker. This is Intuitive Surgical. Apple is a little bit different. And if you spend a lot of time getting familiar with Apple, you'll know that what's in here is earnings, but also product events and also the market, because Apple is such a huge part of the major indices, both the NASDAQ and the S&P 500. There's the dog wags the tail wags the dog. There's volatility from the overall market that comes in here. And it doesn't have to have these predictable patterns. I usually use Bank of America as an example of one that doesn't usually have those patterns, And if we just don't look at the far right here. So if you look at over a period of time, Bank of America, I know this looks volatile, but if we look at the scale, it's really not very volatile. It doesn't usually have earnings related moves. And what's happening right now, this is, we're right in the middle for, if you're watching this later, this is the banking crisis when Silicon Valley and all the stuff is hitting the fan. So there's a huge change in implied volatility, and this, there's opportunity here to trade this, because
I was just going to say there's an opportunity right there to trade. What do I learn from this? Well, once this banking crisis passes, which it's in the process of doing, right? The FDIC's helped facilitate the sale of Silicon Valley's assets. It's calming down a little bit right now. We're seeing the financials rally on this news. If and when all of that fear gets out, that gold line is going to come back down to its normal range, which means the pricing on Bank of America options that might be elevated right now is going to come down.
So this is a 48-month chart, and I would challenge you to find earnings in here. And you don't see the banking sector normally have the same sort of charts that we see in like a Foot Locker, where that you've got this sinus rhythm. The reason is because well, first of all, why does Foot Locker spike like this? It's because the information only comes out once a quarter, and they're very good about holding that information close to the chest. And then they release the information, and there's certain equities that are like that. Netflix, Tesla, Apple is kind of in the middle. But one of the things about Bank of America is because it's such a huge bank and it's regulated, that the data that affects the earnings of the bank are reported weekly. So that information is so high frequency, earnings tends to be not a big event. And that's okay. I'm not saying it has to have a predictable pattern. You just have to have a good sense on how volatility changes. And this is a 48-month chart. So this is the COVID crash. So this volatility that's here is from the market. And these other spikes here as well, if I was to look at the VIX or the high volatility index for, say, the FLX, or for SPY or SPY, the S&P 500, it looks very similar. So Bank of America tends to move with the market. What's happening right now is something special. And as Greg mentioned, both of us look at this and come away with, there's probably an opportunity for a Vega negative trade here. There's probably
covered call.
Yeah, some sort of trade, right, where the volatility drops is going to help us. But that's the fifth thing that I think is important in terms of when you're looking at option chains. We want tight bid-ask spreads. We want lots of expirations. We want penny-wide increments. We want lots of strikes, and we need to have volatility that we understand how it changes. Those things together make for really good option chains and allow you to really take advantage and be able to make money in directions other than just the stock going up or going down if you're short.
And to go back to that analogy as we wrap up, this piece, to go back to that analogy you started with, it's using the tools. It's recognizing that these options are tools, and you're fine tuning the instrument to saying, this nut that I need to tighten is a 1/2-inch nut and versus a 5/8. And so I'm going to grab the actual correct wrench rather than trying to tighten it with my hammer. Which just doesn't work, right? And so this is some of the fine-tuned tools that you'll be able to do to help increase your profitability, increase your ability to stay in trades longer and not have emotion impact them, which is sometimes the most important thing in trading, is controlling those emotions. So using the right tools is an important part of building your success long-term.
Yeah. So my analogy about a hammer, stock buying is a hammer. You try to find a nail, right? That's the other analogy I like to use with tools is that every tool is a hammer except a screwdriver. It's a chisel. And it's a little bit of a joke, but the point that I'm trying to make is, my dad taught me use the right tool for the job. And we have a whole plethora of strategies that we can use where we can leverage the three big things that affect option pricing are stock price, time, and implied volatility. And we can put all three of those working for us. And you'll find yourself being much more successful when you expand your horizons beyond just a stock trader. Buy stock, stock goes up, sell it, or whatever. Option traders can really make money in more than one direction.
Hope you've enjoyed the content today, folks. Don't forget to like and subscribe, and love the questions too. Keep them coming, and we will try to both respond in the comments below, but also maybe make recordings of new questions and continue maybe some of these ideas of where investors make mistakes.
I'm going to make a plug. I agree with all of that. I'm going to make a plug for those of you that are members of Trader Oasis. Our friend Lex Lutheringhausen, who's a former market maker and works with us at Tradier, is going to do a deep dive with us on looking through the platform and looking at volatility. We just talked about a little bit about implied volatility, and it's a very powerful tool. I always tell people it's like an onion that you kind of understand it, and then you realize there's another layer. And we're going to dive deep into some of these tools that exist in the platform to help traders understand and leverage this volatility, because there's some really cool stuff like this dealer gamma stuff, being able to use some of this, looking at implied distributions and term structure, helping us identify things that are on the horizon. So this Wednesday, Lex and I are going to do a deep dive, and it will be available to all members. And you can either watch live or catch the recording later. So check it out if you're a Trader Oasis member. Membership starts at $10 a month if you're interested, with commission-free trading. So check us out. We'd love to have you a part of the community.
Thanks, guys. See you the next one.
All right. Bye, everybody.